by stronger than forecast important. Well, of course, consumer spending accounts for more than 2/3 of the U.S. economic activity.
In a separate report, the Commerce Department says U.S. construction spending unexpectedly rose in January, gaining 0.1%, an increase in private construction projects, offsetting a drop in public spending.
Plus, Citigroup stock lowered today, partly because of the crisis in Ukraine. We're still waiting to see reporting on the back of what Charlie Gasparino says is a potential sanction when it comes to freezing Russian assets, but also because Citi has received subpoenas from the FDIC and the U.S. Attorney's Office for Massachusetts. This after the bank said it had found allegedly fraudulent billings in its Mexico unit. A lot going on today, and after the bell has it for you, we're starting right now.
Time to break down all of today's market action. We have Pete Lang, Lang Capital President, who's going to tell you why you should be looking to invest, get this, in cash. He's going to go over in cash. Lincoln Ellis is here in New York today, Green Square Capital Managing Director. He's here to tell us why he thinks emerging markets will provide investors with significant opportunities. And Alan Nuckman is joining us from the pits of the CME. Alan, sort of in that run-through that we began at the top of the hour, we didn't talk about commodities. Of course, oil is really popping. Is there any indication that the oil jump is perhaps an overstatement on the crisis?
I don't think so. There's a lot of issues with the geography of what's happening here. It's more impactful on natural gas. But anytime there's any geopolitical concerns, oil has a bounce. I think also part of it is on Friday, the dollar index went below 80 for the first time in a long time. That adds support to gold and to oil. From a dollar standpoint, you're seeing a little bit of a delayed reaction there, but that accelerates both the trends on the upside and in commodities that have been beaten down for a long time, obviously.
Pete, I'm wondering if your call on going more heavily weighted toward cash is a little late, especially in the wake of what's happening in of course, Eastern Europe. What I find interesting is, and let me just clarify, you're in about 5% cash right now, but you want to go to 75% cash?
Well, Liz, that's just a possibility. Again, we remain about 95% invested in this market, but we're not trying to predict the future. We're trying to use trend analysis in order to move to cash in the future. I see a lot of volatility, and it appears to me that the Fed is going to have to get off of this quantitative easing program.
Okay.
And when it does, it could spell bad news for the markets.
Okay, so over time, we don't want to mislead viewer investors because it says you're recommending 75% in cash. Not right now, but over what, a span of about the next 8 months?
I think you have to define your sell discipline, Liz. So the thought is this: when am I going to move parts of my portfolios to cash, commodities, or other type investments? And again, you've got to have an objective standard in order for that to occur. So both in our bonds and our equity positions right now, we have an objective path to cash. That is, we know, following a trend analysis, if X or Y occurs, we're going to move our positions to cash.
Lincoln, one thing we know is that emerging markets have already been beat up this year, and you look at what's happening, the political risk factor in any investment, in any country investment, has increased as a result of what's happened in Ukraine. I'm thinking, however, that those who don't panic when there's a crisis but think of how to spend their cash may be thinking, boy, now is the time for great opportunities, or at least beginning to set up some cash for these opportunities in emerging markets. What do you think?
Yeah, I think that's right. First Rothschilds and then Buffett, knowing that when there's blood in the streets is actually an interesting time to consider and emphasize the point, consider actually looking at these markets for purchases. And so what we had anticipated coming into the year, that we would see more volatility in the markets. We had been at historical lows across all of the asset classes, and that we were unsurprised, given the level of geopolitical calm that we'd been experiencing over the last 24 months, that we would see something post the Olympics that would begin to unfold, and whether that was going to be in Southeast Asia, again over the Diaoyu Islands, or something in the Crimea. Well, we know which way that one turned out, but there are significant opportunities when you get price dislocations like the ones we're seeing today.
By the way, I just want to emphasize, you're not suggesting investing in Russia or Ukraine bonds or anything like that. You're thinking of the spillover in the other emerging markets may be overwrought.
That's right, and you see it across all parts of the emerging markets, both in Latin America with the Venezuela situation, again in Asia, and now in the Middle East, both post post-Syria and now post the Crimea Peninsula. Poland, a great example, down some 5 or 6%. Somebody seems to be worried that the next annexation is a country just to the west.
Yeah, this is a developing story. I know, I hear you, Alan. I know that we're not sure about what's going on, but we are sure of one thing. The Russian ruble dropped the most it has ever dropped. It dropped to its lowest level in history. We know that assets tumbled. We know that Eurobonds slumped. We know corn was up. Things like wheat, because, of course, Ukraine is a very big exporter of those things. And then the oil market started jumping, too. You tell me what was most dramatic to you in the pits of the CME today.
I think it was the calm. We're essentially above where the market opened when the stock market opened cash-wise, and we had a sell-off during the course of the day. I saw some great bullish divergence, meaning the bond market wasn't as concerned about this as the price was. We went down and made lows in the S&P, but the bond market did not make new highs, didn't get close to the day's highs. So that's very much a positive. People are making a lot of assumptions here. Let's remember that Russia defaulted in 1998. That did not bring the world markets to a crash. So everybody has to put in perspective, we made new all-time highs on Friday. The markets are looking for an excuse to take profits, and that's what this probably is. Do not extrapolate this into a greater concern. You want to see where we are by the end of the week. 1850 in the S&P is a crucial weekly pivot. The VIX right now is not even at that halfway point of this recent high at 2150 to this low at 1350. So
all right.
let's not get ahead of ourselves.
I understand, but at the same time, we have to remember, Pete, that in the default, in the Russian default, we didn't have the possibility of Russia returning to the Soviet Union. They weren't about to invade their neighbors as they are doing right now. I mean, this is an invasion. Let's not try to candy coat it in any way. It's an invasion. Hold on a second, Lincoln. It is an invasion of a part of Ukraine, and there is a suggestion, a very clear one, that they're going to go into eastern Ukraine. After that, who knows where. So, I mean, there are geopolitical extrapolations from what's happened so far that could infect worldwide investments. No, Pete?
Dave, we've got a lot of volatility in commodities, a great reason just overall to be leaving the energy sector right now, even domestically. So be very careful in commodities. Watch out for the energy sector. There's some great sectors we have right now. Reinvest into health care, financials. I love technology. Those are great safer haven, so to speak.
Okay, now we get to Lincoln. It was actually Alan who was trying to interrupt. Poor Lincoln's all quiet and polite. But you've got a lot under the surface here, Lincoln. What do you want to say about this? And clearly there are people who don't think this is a black swan event. Do you?
No, this is not a black swan event. I think Alan's initial analysis of the technical aspects of the market are actually spot on. The bullish divergence, particularly in the bonds where we all know the smart money is, really told us that calm was actually the underlying factor that penetrated this market today, and that the kind of selling that we saw both in the Russian ETFs and Poland, as I mentioned earlier, is really just the initial knee-jerk reaction to some assets flooding, removing themselves from immediate harm's way. But the larger picture is much more bullish. We continue to see ISM numbers regaining a little bit of strength, spending regaining a little bit of strength, wages even up 0.3 today out of the ISM. And as we move later on in the week to see how we're doing in the jobs numbers, that's really where the markets will begin to respond. If we get more wage gains out of the BLS numbers and slightly better unweather-hindered numbers out of the U.S. employment sector, the issues that are going on in Europe will begin to fade a little bit, and people will begin to put them in perspective that this is geopolitical and sort of ring-fenced for the moment.
Okay, Alan Nuckman, let's go to gold for a second here. We saw a $30 jump. That's not unexpected when there's a geopolitical crisis, but is that perhaps overbought right now? Do you see gold reaching a point where maybe it's time to think about selling?
I've always been a fan of the distressed assets, and gold was a distressed asset. We talked about it many weeks ago. It had a double bottom. 1,400 is the target. That gold had traded between 1,600 and 1,200. 1,400 is the midpoint target. So I still think there's more upside in that market, and I still think a lot of people have left it alone. So that, to me, is a positive. Again, my wild card is the currency. As the dollar index continues to push lower, that's supportive of a lot of these commodity assets. And, you know, I agree about the ring fence analogy. technology. Right now, that's the situation we're in. The market being down less than 1%. Is not catastrophic considering what's happening. You've got to follow what the markets are giving us, not be emotional about what we think could happen in the future. I trust what the markets tell us.
Well, they are being cool right now, no doubt. When you think of what could have happened today, a lot of people were suggesting would have happened. It didn't happen. This is a down day, no doubt about it, but it's much better than it could have been.
Indeed. Our thanks to Pete Lang, Lincoln Ellis,
Thanks,
and
guys.
Alan Nuckman. We're going to check back with Alan in just a minute for the S&P futures close.
Well, Ukraine's prime minister says his country is, quote, on the brink of disaster and is asking for a $15 billion rescue from the IMF. Now, what does that crisis mean for Ukraine's economy? And will business activity throughout the old Soviet Union begin to dry up? We're talking to two investment gurus who've been working in the Ukrainian region, one of whom is there right now. You don't want to miss this interview coming right up.
Plus, fears of supply disruptions sending some commodities like the ones on your screen, particularly wheat and corn.
Wow.
Those crunches there, is that going to